Hello, welcome back to another week of your Mortgage Market Movers Weekly, where we are detailing everything that's going on in the macro economy to help you make better home buying decisions. This week's 30-year fix is sitting at a 6.22, which is up from last week's 6.17. Nothing really big in the economic calendar for this week. However, it does look like it's very possible that the government will be reopening. So we are going to get a lot of data coming in. So we're going to be on the lookout for that. So let's get on over to the charts and see what it looks like. All right, back over to the charts. So we are on the US 10-year, and right now we see that around the end of October, that is the lowest that the US 10-year has been in quite some time. Let's see. Other than that, it was back in April of 2025, and before that, around September of 24. So 4 is a pretty significant number in the US 10-year, and if we can stay below 4, that'd be pretty beneficial for the 30-year fixed rate. I'm not really assuming that we're going to stick and sustain below 4 until the Fed cuts rates, but a good bit more than they've already cut. And there's definitely a misconception that I've addressed, but I'm going to address again. The federal funds rate is what the Fed cuts, and that is the borrowing rate. This is not the mortgage interest rate. Mortgage interest rates are based on the US 10-year. And the US 10-year is this is the US 10-year yield. And this is the yield that you would get from the US 10-year bonds. So if you are interested in keeping up with interest rates, you should look at the bond market and see what the bond market is. And that's why we look at the TLT. This is the proxy that I use for the bond market. And as you can see, there's an inverse correlation. So this blue line is the bond market. So when this blue line is up, this is going to be coming down. Like I said, inverse correlation. And that's because as people buy into bonds, the demand, of course, is going up, which means you can have a lower yield. A lower yield means lower interest rates for the 30-year fixed. As people are selling bonds, the demand drops, so yields have to rise to make bonds look more attractive. So it's really important to just kind of be aware of what impacts the interest rates and not just think, well, the Fed cut rates, so this means that interest rates are going to drop, because you will definitely get disappointed. So we just had an interest rate cut. When was it? It was in October, at the end of October. And rates went up from that. Now, the reason that rates went up is there's a few different things. It's important to understand that the bond market, and really all of these markets, these financial markets, are forward-looking, and they are looking towards the future to make expectations to price things in. So the price that you're looking at is based off of all of the available knowledge about what will happen in the future. So rates the US 10-year was falling, and people were buying into the bond market as the rate cuts were coming up, because people's expectations were that rates were going to be cut. And it's almost like a buy a rumor, sell the news type of deal. So because everybody knew that the Fed was going to cut rates, it was like a 90-something% chance. Bonds were being bought, 10-year was coming down. But then you had to take a look at what Jerome Powell is saying during his press conference, because that is giving you a picture for what the future of the Fed looks like and what is likely going to happen. And at the last Fed meeting, Jerome Powell, the chair of the Fed, said that it is not conclusive that we are getting another rate cut in December. It is, I believe he said it was not a foregone conclusion, far from it. So that means that investors got a little spooked, and the probability of a rate cut dropped a good bit. I think from like an 80% or something. It's probably around a 60. We can take a look at that. So it's just important to really understand like what is causing all of this to happen and what is the reason for the interest rates to drop, because which is 30-year drops because the US 10-year drops, which that drops because bonds rise, okay? And bonds rise for a multitude of reasons, but one of them is expectations about future events. So just keep in mind, Fed rate cuts do not just mean lower rates definitively. All right. So that's all I had to say about that. When we get over to the economic calendar, let's see. We have the 10-year bond right here, which was at 4.07. So this was the top bid for that 10-year bond. Previously, it was a 4.12. Then the 30-year bond is Thursday. Really, it's just a bunch of Fed speak this week. Next week, though, let's look and see what happened last week. I don't think we went over some of the stuff last week. So when we look at the services PMI, which is the Purchasing Managers Index, when we look at services, and this was, let's see, I want to say, okay, so the services was expanding, right? Anything above 50 is expanding. It's not right here, but I want to say the prices paid on services was up, which leads to the assumption that inflation might be up. We are getting hopefully if the government opens, which I believe they're voting today, which is Wednesday is today that I'm recording this. I believe they're voting at 5 p.m. But if we can get that, then I don't know when. I thought that we were getting CPI data. When do we get CPI? Okay, we'll get GDP November 26th and then PCE month over month on November 26th as well. So that looks to be the next time we see anything about inflation. I did just see something from the White House stating that it's very unlikely that we will get anything from the October data. So all that data from October that we didn't get because of the government shutdown, the labor and inflation data, it looks like that might not come out, which, I don't know why they would do that, but seems a little fishy to me, but I will refrain judgment. Mortgage delinquencies would be interesting to see on November 13th, which that would be tomorrow. So we might get that. It's anything that's tentative is because of the government shutdown. So if the government reopens, we might get this information. But really, in the short-term future, what we want to keep an eye on is probably maybe this manufacturing and services PMI. And then the meeting minutes might have something in it. And if there's anything important, I'll be sure to mention it. Unemployment claims, though, if the government reopens, this will be the first bit of labor data that we've gotten in a while. And then existing home sales for next week. Like I said, the 30-year fix is at a 6.22, which is up from last week's 6.17. And I guess while we're here, let's take a look and see what the probability is of the Fed rate cut is. Let's see. Fed rate cuts 2025 projections. Oh, yeah. The Fed Watch tool. Let's see. So we want probabilities. Okay. It's at a 65.4% of a rate cut on December 10th. So, higher than a 50-50 shot. And we really just have to wait and see what the data says to see if we will get a rate cut. I know at one point it was projected to have rate cuts into 27 out to 275, 300, and that has shrunk back to 300, 325. I think once we get to this area, so sometime in like mid to late 26, right? If and this is so far into the future, who knows what the data is going to look like, but let's just say these probabilities were accurate and this is when we got this rate cut. That's when the 10-year could probably come down a good bit. I think the spread between the Fed funds rate and the 10-year is usually, I've heard from people it's usually about like a 1% spread. So, yeah, it wouldn't make sense right now for the 10-year to be too much lower than 4%. Because right now it's 375, 400. So maybe it's not a 1% spread, but anyway, yeah, it's and unless like the bond market just really picks up because of some kind of black swan event where people are flooding out of the stock market and into the bond market for whatever reason, then we probably won't see anything too crazy. But anyway, that's what we have for the probabilities, and that's all I have for you this week. So if anyone has any questions about any purchases or refinances, definitely give us a call at 877-TEAM-MBL or visit us at www.mortgagesbylinda.com. All right, have a great week, everyone. Bye.